Good morning, everyone. Thank you for joining us. I want to wish everyone a Happy New Year. As always, I have joining me today Gareth Watson, Director of our Investment Management Group at Richardson GMP. But before I hand it over to Gareth, I wanted to review 2014. 2014 provided another good year for our investors. It actually emphasized the importance of diversification as the different asset classes and regions performances varied. The Canadian dollar continued to slide in 2014, but the two biggest surprises were the bond markets and the oil prices. Most people were wrong in thinking that interest rates and yields would climb up in 2014. Interestingly enough, they actually declined down to 1.79% for the 10-year government bonds in Canada. That's down from 2.76 at the start of the year in 2014. In the U.S., the 10-year treasuries came down from 3.13% to 2.17. Quick lesson on bonds is that when yields go up, when yields go down, bond prices go up, and vice versa. If bond yields go up, bond prices go down. So bond returns were much better than many had expected. In the past 2 weeks of 2015, the yields have continued to decline, and yesterday the 10-year Canadian government yields touched 1.35%. The Bank of Canada surprised everyone and lowered the overnight rate by 25 basis points, or 0.25% to 0.75%. This caught many by surprise, including 72 economists, of which, when polled regarding the possibility of a rate cut, 0 of them forecasted it. This was done by the Bank of Canada based on the most talked about topic, which are the oil prices, which declined in 2014 by 41.6%, ending up at $53.27 a barrel. Today it's even lower at $47.28 a barrel. Hence the concern by the Bank of Canada, especially in our western part of Canada, especially specifically in Alberta. As you can see, I'm going to quickly go through the performances of the major indices. The S&P TSX in 2014 was up 7.4%. The S&P 500 was up 11.4%. MSCI Europe, Australasia, Far East Index was down 7.3%, and the Emerging Market Index was down 4.6%. As mentioned, the DEX bond was a surprise of 8.78, and WTI, which is the oil prices, was down 41.6%. The other component of this is how the Canadian dollar, the slide of the Canadian dollar, how that's affected. So in Canadian dollar terms, the S&P 500 actually had a total gain of 21.9% due to the decline in the U.S. currency. Due to the decline in the Canadian currency, and the other major indices such as MSCI UP was up 1.4%, and emerging markets was up 4.3%. So you can see the effects of the decline in Canadian currency on global investments. Now what I'm going to do is I'm going to hand it over to Gareth and provide us his outlook on 2015. The start of it has been pretty exciting, to say the least. So I'll hand it over to Gareth.
Great, thanks, Frank. And thank you to everyone for joining us today. Just going to touch on some slides here. There's obviously a lot that we can talk about in the markets, even in this past week, but I'll try and touch on some of our major themes for 2015. And at present, I'm currently referring to a report that we launched yesterday, was published yesterday, that you can certainly get from Frank, our 2015 market outlook commentary, and just some of the larger themes that we've touched on in this report, and which will provide a bit more detail in terms of what I'm talking about today. Number one, global divergence is going to continue in 2015. What we mean by that is, certainly during the downfall of the markets, the global economy fell together. We've had a bit of a recovery together. It's obviously at different rates of growth in different regions around the world. But now we're starting to see some divergence amongst countries that have participated in that recovery, whereas the Americans are really starting to accelerate in terms of growth, We are seeing, obviously, the Europeans head in the opposite direction. We've seen Japan continue to stagnate. We've seen the emerging markets run into some headwinds. And, of course, here we're starting to talk about what's happening in Canada. It's quite clear that the United States is the economy that has outperformed in 2014 and will continue to outperform in 2015. And to be honest, if there really is a risk, I mean, I know we talk a lot about risks, about things that are going down, but I think one of the greater risks in 2015 is the U.S. economy. And I don't mean that from a negative standpoint to say that it's going to fall, but because the world seems to be hanging its hopes on the U.S. alone, if there is any signs of weakness in the U.S. later on in 2015, that could certainly cause some problems for the market. We're not necessarily expecting that, but that is, I think, is where the largest risk lies for the outlook globally for 2015, because we already have pretty negative expectations for a number of other economies around the world.
So is it safe to say here that we're going to keep a close eye on the growth rate of the U.S. economy for 2015, which will entail the benefits or issues or concerns globally based on what happens?
Absolutely. I mean, we always pay close attention to the States no matter what, but I think there's just an added bit of attention to it this year because it really is, with the exception of a couple of emerging markets out there that are not doing too badly, such as India, it really is the leader right now that's taking global growth higher. So you're seeing a lot of forecasts out there over global growth coming down, such as from the International Monetary Fund and the World Bank. That's being driven predominantly by, of course, countries other than the United States. If the United States were to show at least some signs of weakness going into the end of 2015, again, we're not expecting it, but if they do, that could have some very negative connotations for the stock markets in terms of the performance that we've seen over the past couple of years. One thing that certainly was non-existent, particularly in mid-2014, that we think has, well, first of all, it has returned, but it could certainly be around for most of 2015, is volatility. And this is not just in stock markets, this is also in bond markets, in currency markets. The volatility as a whole, we think, is going to become much more topical. It's not to say that it's a guaranteed negative. I mean, volatility can work in your favor if in fact, you have rallies. But in terms of the quietness that we had mid-year last year with respect to the markets just chugging along, not much happening, we don't think that we're in store for that this year, and that things could be just a little bit more volatile in general. The U.S. dollar has been a rock star for some time. We think that that is going to continue, mainly because many other currencies around the world, it's really difficult to find a reason why currency traders are going to want to buy them, especially this morning with the Europeans announcing their $1 trillion worth of bond purchases over the next couple of years. That's obviously put some pressure down on the euro. The Japanese have been trying to weaken their currency for the past couple of years, and there doesn't seem to be an end in sight on that. Obviously, nobody wanted to own the Canadian dollar yesterday. The Swiss, of course, have unpegged their currency from the euro. So you go around each of the world's major currencies, it's very difficult to find one to buy other than the United States for good reasons. And for that reason, we think the U.S. dollar is going to continue to outperform. Admittedly, it could be a bit ahead of itself right now because so many investors are turning to the U.S. dollar by default that it could very well be overvalued, but we still think that there will be some momentum going towards the U.S. From elsewhere in the world. And, of course, that will have some negative connotations for the Canadian dollar, which I'll touch on momentarily. Inflation, we were talking about inflation a couple of years ago. We don't talk about it anymore because it's not really here that much. Instead, you're probably going to hear more about deflation in 2015, namely in Europe. Of course, a lot of oil with the energy prices coming down. Even though most central banks tend to look at indicators that exclude food and energy prices, you can't ignore the fact that there's a deflationary effect here from lower oil and natural gas costs, and that, you know, when you have an economy, you do want to see gradual price pressures upwards. That means that the economy is strong, and that means that demand is outstripping supply. And for that reason, inflation is a good thing to a large extent in terms of recognizing the health of your economy. If you're seeing the opposite happen and prices are falling, that is not a good sign, and certainly maybe another reason why we saw the Bank of Canada move yesterday. We still do have a marginal preference for U.S. equities over Canadian equities. This is predominantly built on the fact, again, we still, even with commodity prices coming down as much as they have, and energy, or I should say commodity equities coming down as much as they have, they still have at least more than a third influence on the TSX index. We don't necessarily see that improving, especially in the first couple of quarters of the year. The bank should hold in relatively well in Canada. although that could easily change depending on the outlook for the economy, particularly in Alberta. But based on what we've seen in the composition of the indices in the United States, it's likely that you'll continue to see the U.S. outperform Canada in 2015 for yet another year. With respect to the energy markets, obviously extremely topical. Where's oil going? Where's it going to bottom? How low can gas prices go at the pump? I'm not actually going to have a specific answer for you today because I simply don't know. And the reason why I say that is because I don't think anybody knows. With the way that forecasts have changed here over the past 6 months, from these oil economists that were happy with $100 a barrel 6 months ago and are suddenly calling for 45 now, makes you wonder if they really know what's going on, quite frankly, because obviously they didn't 6 months ago. But I'll touch on that later too once we get to commodities. I'm just going to briefly touch on monetary policy. Things have changed. If you were, we did this last year. You know, the general consensus amongst most central banks, of course, was basically to hold steady. Not much of an outlook in terms of change, whether it be raising rates or cutting rates in most of the world's economies. For the United States, that basically held true. In Canada, that basically held true. The Europeans eventually were forced to cut rates towards the end of the year. And Japan, while they didn't cut rates, because really in Japan you can't cut them that much more, they certainly went to town on quantitative easing, printing a lot of money, buying a lot of bonds, trying to keep borrowing costs low. But looking into 2015, there is a difference amongst the major economies. That, of course, includes Canada. First and foremost, we are expecting at some point in 2015 the Federal Reserve will actually start to raise rates once again. Don't think it's going to happen in a quick and violent fashion. Probably slow and gradual over a period of time, but at some point we think the Fed's likely going to move in 2015, probably more towards the second half of the year. The United Kingdom, even though they're going into an election this year, usually when that happens, the monetary policy kind of goes quiet until we find out who the new government is, but they are possibly in a position to do the same. I wouldn't put as much money on the UK doing it as the United States, but they're in a position where that could happen. Japan, you're not going to see rate changes there at all. You're going to see continued bond purchases. Europe, likely not going to see interest rate changes, again, because they're quite low already. But you've already seen today's policy announcements with respect to the bond buying. And Canada, so we got a rate cut yesterday. Can we get another? Absolutely. And, you know, to have an influence, when you have 1% interest rates, I mean, even cutting them by 25 basis points, it's really not going to make that much difference to the overall economy in this country. And if you cut them by 50 basis points, you can even argue that's not much of a change. I mean, when we normally go through rate cuts to stimulate the economy, it's because we're at 6 or 7% or 5 or 4%, and we cut them by 150 to 200 basis points. We don't have that luxury because our rates are already as low as they are. So, yes, perhaps this was a preemptive move by the Bank of Canada, concerned about what they're seeing around the world. And it is quite possible that you could see another rate cut before rates go higher in this country, which obviously is now, I think, a complete write-off for 2015.
So just to interject a little bit, just so the listeners can understand, the Bank of Canada controls the short-term rates, and they can cut that immediately. The bond buying program actually is a way of somewhat controlling the longer-term rates. So just so listeners can understand the differences between what happened yesterday with the 25% basis point cut and what's happening in Europe now where they're doing some bond buying.
Correct. So for example, when we speak about government bonds, we tend to focus on 10-year government bonds. It's not to say that it's always the focus, because when these central banks do their buying, they usually do it across the curve. They'll do 5 years, 10 years, 30 years. But we, you know, and I'll show you here a chart shortly with Europe with respect to comparison amongst bonds. We are concerned with the longer-term borrowing cost, not necessarily the cost tomorrow or the next month, but, you know, 5, 10 years from now, in terms of what the market's pricing in, because that is, you know, especially when it comes to government borrowing, those are the timelines that these governments have to deal with in terms of paying that debt back and obviously trying to keep the interest payments as low as possible. And as Canadians, I don't need to remind you that back in the early 90s, it was close to about 40 cents of every dollar in revenue that came into this country went to the interest payments on our debt before we got our act together and started paying that debt down. And we've been fortunate, of course, also that we've been able to refinance at lower rates over the past almost 10 years now. So Just touching on the United States very briefly, why we like it. You can't really argue with 5% GDP growth. Let's remember, China just posted 7.3%. The Americans actually aren't that far behind the Chinese, so who would have thought that was going to happen a few years ago? But the American economy is doing relatively well. Yes, you can spin it a number of different ways depending on your political affiliation, but on the whole, the economy is doing much better today in the United States than it was, let's say, a year ago, 2 years ago, and definitely 8 years ago, or I should say 6 years ago. Lower oil prices obviously going to help consumers. It will have a bit of a detrimental impact to the United States economy because a lot of the growth in the United States has come from the fact that their energy sector has exploded. Well, when we used to talk about Fort McMurray being such an expensive place because that was the place to get a job and get paid well, and you couldn't find a home because everything was doing so well, that's basically what they're finding right now in North Dakota. You're seeing a repetition of what happened in our oil patch, let's say 10, 15 years ago now in certain states in the United States where they didn't have this industry before, and now they have it. Obviously, tons of jobs being created, obviously millions, if not billions of dollars being poured into capital expenditures. Some of that's going to disappear now. So some of the momentum that drove the growth higher is going to disappear, but hopefully the lower oil prices will get consumers back into a buying mood and they can make up for that lost investment that would be coming from the oil and gas industry.
Because they're still net consumers of oil, the U.S.
Correct. They're still importers. Admittedly, this whole move on oil, I think, is some of the superpowers in the world trying to readjust the supply-demand balance kind of away from the United States because they've been producing so much and moving it back towards the Middle East. This is more of a geopolitical issue than it is an economic issue. But regardless, the United States is still a net importer of oil. On the fiscal picture, the government balance sheet is so much better today than it was just a couple years ago when we were talking about government shutdowns and debt ceilings and defaulting. And of course, the U.S. economy, or I should say the U.S. government, was downgraded by some bond rating agencies. But that was back when the deficit was about $1.2 trillion. And long story short, they've gone through some pretty, well, actually, it's quite amusing political maneuvering here that's actually managed to get that budget deficit. I think they're now down around $600 billion. So they have slashed that in half in a very short period of time. Obviously, that's a very good news story for the Obama administration, considering that, of course, they were being labeled as incompetent on the economy, or at least on the government finances just a couple of years ago. In corporate America, this is why you've seen the stock market returns that you have. They've done very well relative to expectations for the most part. The balance sheet's obviously looking better. They're still able to make a lot of money on this planet, even though we've got some difficult economic conditions elsewhere in the world. They've really done an excellent job since 2008 trying to deliver value for shareholders, whether it's through growing earnings, whether it's through returning cash to shareholders. And now, in the past year, we saw a lot of M&A activity trying to drive value. And now we're hoping to see more capital expenditure investment in the economy, which is only going to help GDP going forward. On the European front, there are some people that are concerned that we could fall back to what we saw back in 2010 with respect to the Greek crisis because things are not as good right now in Europe as they were, let's say, a year or two ago. It is true. There is a difference between now and then, though. The weakness is being driven predominantly by Germany and France, whereby in 2010, Germany and France were actually doing well while all the other countries were struggling. And it's very influential, Germany and France, because together they make up about 50% of Eurozone GDP. That's 2 of 19 countries make up half of the economy, basically. So if we see a turnaround in Germany and France, without a doubt the Eurozone will take off. The good thing for Europe right now compared to 4 or 5 years ago, financing costs are low. Their banks are in a better position because they're able to clean up their balance sheets and shed a lot of the bad debt, even though the European Central Bank basically told them all to buy Greek debt 4 or 5 years ago. Not a good idea. The euro has finally weakened. The European Central Bank has been waiting for this for quite some time. When nobody wanted to own the U.S. dollar, everyone turned to the euro instead, so it worked against the ECB. Now, of course, everyone wants to own the U.S. dollar, so they're all dumping their euros. This is good for the European economy because the lower the currency you've got, the more exporting that you do because your goods are cheaper. Also, there's not as much pressure on some of these countries to deliver the austerity budgets that they once had, which really did strangle investment, not good for growth. And if there is a region in the world that will benefit from lower energy costs, it is Europe. They rely heavily on importing energy, whether it's oil or natural gas. Of course, this has become more topical. For example, for those in the south, importing from places like Libya, those in the north importing from places like Russia. With all the geopolitical issues that have been going on in places such as those, there was always a concern that higher energy costs were going to strangle the European economy, but of course with this decline that we've seen, it's looking a lot better for them. And if you look here at borrowing costs, the only bonds, and again we're looking at 10-year yields that have gone up recently, and this is more because of the political instability in Greece right now as they go to the polls, and it looks as though the if I could call it the not-so-pro-Euro party of Syriza could very well form the next government. The market's not liking that as much because Syriza, I believe, has said that they don't think they need to pay back the ECB all the money they gave them. Obviously, bond yields in that country have gone up, but everywhere else, bond yields are still very low, which is very good for government financing down the road.
Sorry, I want to just go back to that chart quickly, and for those of you that have listened into our conference calls, I think you can remember times when, even in 2012, when you had those Greek bond rates and Spanish bond rates 10 years at 15, 16%, and now they're well below 5% on those 10 years. So how times have changed in such a short time frame.
Yep, and in fact, before Greece went bankrupt the last time, they were up at 25%. They don't tell you that they went bankrupt, but basically they went bankrupt. Canada, admittedly, you look at the energy markets, and let's face it, our economy here is regionally focused when it comes to economic activity. It's very different in Alberta than it is in Ontario, and it's very different in Ontario than it is in Saskatchewan. It's different in the East Coast. So very regional disparities here on the makeup of our economies. Obviously, Ontario and Quebec haven't done as well over the past almost, let's say, 2 decades because of the resource boom that we've seen. It's not just oil and gas. You have to remember that we also saw big rallies in things such as fertilizer prices and mining stocks and gold, and a lot of those assets were located out west from parts of Manitoba all the way out to British Columbia. So Western Canada has been the beneficiary of all this. That's starting to reverse. And obviously, Ontario and Quebec not being helped in the past also by the higher loonie, because we used to have a manufacturing base in this country in central Canada, excuse me, and that base unfortunately has slowly cracked and disappeared over time, but a lower currency certainly does help the economies in central Canada more so than in Western Canada. And so my point being here that, yes, declining energy prices are certainly not going to help certain parts of the country, but a lower loonie definitely will. Now, there's a lot of debate about balancing our budget in this country, and I find it almost kind of amusing, quite frankly, that we're having this debate that somehow we have to have this budget balanced by the next election on the Conservative side. I mean, even if you miss it by a few $billion, our finances are so much better than many other countries around this world. So if they miss by a couple billion, I don't think it's something that we can, obviously punish the Conservatives for. Let's face it, if the Bank of Canada has just cut interest rates, that's sending a message that they're concerned about what lies ahead for Canada. And the last thing that we want to be doing here is cutting back on investment at this time, because that's what's going to help out the economy. So we'll have to wait and see what happens here on the budget front, but don't lose sight of the bigger picture, which is that Canada is in much better fiscal shape than any other country in the G7, in the G8, and to some degrees the G20. And I just wouldn't lose sight of that bigger picture outlook here for us, fiscally speaking. Now, my only concern about yesterday is we've cut interest rates, and all that we talked about for the past year or two is the fact that Canadians are over-levered on their personal balance sheets. Cutting rates further is probably not going to help that. If anything, it might even make people want to borrow more because it's going to be cheaper again. Let's just hope that doesn't happen, and let's just hope the banks don't let that happen, because there are some Canadians lined up right now in terrible position for when interest rates do go higher because they just have way too much debt. So that is my concern. Yes, it's great to have that bit of relief in the short term, but hopefully we don't get carried away with it, and which will set us up for a much deeper recession down the road. And we will hit another recession. It's just a question of when. Now, the other thing, of course, is that we are going into an election this year in Canada. So who knows what's going to happen here with the budgetary outlook, whether there'll be stimulus spending on its way. I suspect at some point we are going to start talking about having to make investments during these difficult times. Most parties will probably jump on board, which could help sustain the Canadian economy as we hit a few headwinds and a few rough patches here. But on the whole, that will certainly be probably the main election issue, I think, coming up is the Canadian economy as a whole, as it was for the last election as well. My last few comments here, just on commodities. Obviously, a terrible year in 2014 for commodities, namely energy. Don't need to tell you that oil and natural gas were lower last year by a significant amount, and the impact that that's had in this country. But there was basically weakness across the commodity spectrum, with the exception of a couple base metals that held up well, probably more for geopolitical reasons than for supply-demand reasons. But the number one issue here is oil. Where's it going? Where's the bottom? When are we going to bounce back? And as I mentioned earlier in the presentation, I don't know. What I do know is that the market has certainly talked about oil prices. They've done a very good job of doing that. I do know that usually when you think the worst isn't over yet, it probably is. So most oil forecasters out there are calling for prices to rebound in some way, shape, or form with different levels of magnitude at some point in the second half of the year. So if you want vague, I just gave you something very vague. When I hear a lot of people say the same thing, that usually means it's not going to happen. And what that probably means is that the bounce back, however big it is, and I think the consensus out there is that we could bounce to $50 to $60 a barrel at some point this year, is more likely to happen before the second half of the year. I think people aren't going to wait necessarily 6 months. There'll be some anxious buyers out there that could step back in, and that bounce back could happen earlier than you think. But I have absolutely no way of predicting the timing of what's going on here, other than to say that on a more sustainable basis, we probably will see prices stabilize and move higher once some of the superpowers, such as Saudi Arabia, are much more comfortable about where the supply is coming from on the planet. And when they are more comfortable, then they will start stepping back into the process and influencing the supply-demand balance. That's why a lot of these people are saying second half of the year, because that's a process that's going to take at least a couple quarters. This is going to be a sector that will probably provide some very interesting short-term opportunities, but you have to time the market very well to do that. And with most of our clients, we tend to veer away from that strategy because, unfortunately, even though you can do very well, you can also get caught off guard very easily and lose a lot of money at the same time. So at this time, we're not encouraging people to chase oil. We're just waiting to see some type of stability in the sector first before committing money back into it. But at some point, we think the dynamics are going to change in 2015. It's probably more likely, though, in the second half of the year. The TSX index, I've already talked about the fact that the U.S. markets are likely to outperform. Again, not exactly the greatest chart to look at for 2014. We had a few declines, actually. A lot of people remember the second one at the end of the year more than they did the first one at the beginning, or I should say around September timeframe. But again, with commodity prices likely continuing to struggle in the first half of the year, it's going to be difficult for the TSX index to outperform its international peers because of its weighting towards commodities. And if the banks do run into some headwinds because of the economy and because of interest rates and because of the oil patch or whatever you want to throw at them, that's obviously not going to bode well for the TSX as well. And finally here, the Canadian dollar. I had to update this chart yesterday because, as you can see, there's that line that just goes straight down at the end of it. That happened yesterday. So it was just a massive decline in the loonie. We're about to breach 80 cents. Can we breach it? Absolutely. This loonie can go further, a lot lower over the course of 2015. I would note, though, that yesterday was probably overdone. And this is what happens when you have unexpected news that needs to be digested by traders. They do tend to freak out and just punt their positions altogether, and they think about it later. So trade now, think later. And it's not to say that I'm expecting the loonie to rebound in any way, shape, or form, but just be aware of the fact that yesterday was a day that caught a lot of traders off guard, and there was probably some panic selling out there in the marketplace. But the overall outlook, as I mentioned earlier in the presentation, is that the U.S. dollar is still going to outperform a number of currencies around the world. And when we look at Canada, why do people buy the loonie? Well, a lot of them used to buy it because of the commodity complex. I've already told you that that's probably going to continue to struggle. People were holding on to the loonie because at one point we were thinking the Canadian Central Bank was going to raise rates before the Americans. And this is about a year and a half ago, maybe 2 years now, that we were saying that. Of course, that has completely changed, and we are cutting rates while the Americans are more likely to raise rates. So another reason why the U.S. dollar would likely outperform Canada. So in terms of outlook in 2015, certainly you're never going to get back up to parity. It's going to be difficult for us to even think of 90 cents. I think to find some range between 75 to 85 is probably where we're going to stick around for most of 2015. I know that's a huge range to give you, but considering what happened yesterday, I think that threw a lot of forecasts right out the window. People are rethinking their outlook on the currency, and it's going to open up a much wider range of estimates coming for 2015 as to where this Canadian dollar could go. And again, there is now an expectation that we could get another rate cut if things don't improve here in Canada, or at least what the Bank of Canada is looking at, which could easily take the loonie lower, obviously into the 70 range.
Could that be neutralized a little bit by the potential rise in oil prices?
To some degree. I mean, if you get a bounce back, it'll depend on the magnitude of the bounce back. I mean, if you go back up to 50, 55, no one's going to care. There might be some oil traders that had priced in lower currency traders that priced in lower expectations for the loonie, and that's why it has fallen, obviously, since July of last year to the extent that it has. But on the whole, I think for people to start buying up the loonie again based on oil prices alone, you're probably going to have to see a pretty material bounce back. I think right now the focus is on that interest rate differential, the fact that it's widening, and it's going to expected to continue to widen. You know, we tend to focus on commodity prices when commodity prices are doing well to support why we're buying the loonie. We tend to, I think, focus a little bit more on interest rate policy when the loonie's falling as to why we're selling the loonie and buying another currency.
So it'll be influenced more by the interest rates at this point?
I think so. I think that's really what's going to drive it. It's not to say that oil can't influence it, because it still can, but I think you'd have to see a pretty big rally to get people back on the bandwagon of the Canadian dollar.
Okay.
So those are my comments for you. And again, we do have our market outlook report that we published yesterday that you can get from Frank that goes into a few more details about what I talked about today. But hopefully that's a helpful overview of what we're expecting in the year ahead.
Thanks, Gareth. What we'll do is we'll send out this recorded webinar, which will include the Outlook 2015 piece, along, of course, with the replay of this. So we encourage those listening to feel free to forward it. So, in summary, we agree with Gareth and his team's views that first of all, volatility will most likely be higher than it was in 2014, and based on our strategy of asset allocation. Volatility isn't necessarily a bad thing. We have the ability to take advantage of those. As long-term investors, you want to buy low and sell high, and with volatility, it provides those opportunities. I think the start of the year was somewhat challenging in the equities market, but I think we're recovering. In fact, we had a good increase in the TSX yesterday with the announcement of the rate cut. But again, for those of you that have been listening into our webinars for the last couple of years, what a difference in such a short time, with looking specifically from a U.S. perspective, where the U.S. has gone and where it is now. We had many people writing them off and saying, we don't want to invest in the U.S. Now look at what's happened. And again, this is an emphasis on the importance of asset allocation, how to allocate it both from an asset class perspective and from a regional perspective. This is actually the environment of how we successfully manage money, because different regions, different asset classes perform differently. Anyways, that's it for now, and look forward to a prosperous 2015, and look out for our next webinar and our next O report. Thank you again for joining us.